new market, 2025. Bull market Buzzkill. I was kind of saving this for this year to start off, although I don't necessarily think 2025 is the year for that. But I'm going to give you some data that's showing that it is starting to loom in the future, and I think it's something to be mindful of, certainly going forward. So today, I'm going to start off with the Santa Claus Rally. Well, I don't have a slide for that, but it was basically a no-show between Christmas and the January 3rd. The market really did not do much, and that's usually a very high probability of a good run for the market, which didn't really happen. So that's an interesting way to kick off this year. It wasn't the most ideal. And typically December is one of the best months of the year, and it was down 2.5, somewhere in that range on the S&P, and depending on the index, and even bonds were down a bit as well. So that was not a great month. But today we're going to talk about presidential cycles and what was good, what's bad, what may be coming, what's typical for these timeframes. Recession back on the table. I'm going to show you some recession indicators, forward-looking that we're thinking about. And a lot of things are converging on 2026. So I want to keep that in mind for when to start thinking about these shifts and what to be watching for. And finally, I'm going to go through my standard money flow stats and where we're at and what we're thinking from an allocation standpoint. So let's dive right in. Stocks do better under a re-elected president. So the funny question, and I was speaking with Ryan Dietrich from Carson Wealth yesterday on a webinar, and a couple of these slides are from him because I thought they were great points to bring up for today. But is this a re-elected president? Because usually that's a second-term president, not one that was there and then gone and then back. So that's an interesting twist to this that may mess up the data. I don't actually know. But typically, first year of a re-elected president, or in either case, is pretty good, and that's 2025. That makes this year very likely pretty good. The second year of a new president, if it's new, I think the Biden administration, he was also a new president. The second year was pretty bad. I think 2022 was an ugly, ugly year, and that's demonstrated here. So that's very likely possible. That's also 2026, interestingly. And then you have 2 years after that of decent markets, depending on the situation of the current president. So I think that's very interesting that the Biden administration so far was textbook, and this is typically what does kind of play out. So I'm curious to see if this jumps. All right. And then quarter by quarter of the presidential cycle. I think this is interesting. It's not first quarter, which is where we are now, not a super exciting time, and the market's certainly acting like that at the moment. But then you get a couple of good quarters, hopefully the second, hopefully the fourth, and maybe even the third could be okay. It's not too bad. But once we get to that third year, it gets real dicey, a little bit questionable. Once a new president has settled in, and then you start to see what they're going to do, then the market's a little bit like, yeah, we already know, or surprise, we didn't like that, or something to that effect. So we'll have to see how that plays out. But after we get to the second year, third, fourth are pretty good, especially the third year, which would be 2027. So that's an interesting way to think about it. I was looking at seasonality. This is over the past 7 election years. So actually the 25 years of data is what we're looking at here. And typically the market on the post-election year, first year of presidential cycle, starts off a little bit choppy in January. It's not unexpected or not uncommon to see the market kind of drift down into mid-January before having a little rally into February. But then February and March might be ugly. It's very possible. But then again, we get that second quarter bounce back. Hooray. And then summer is a mess. Fall, August, September is always ugly, almost always. Then does the bottom happen in September, or is it early October or late October? It's very likely we'll see something drastic and dramatic happen around these 3 points. And that's where a bottom could happen for a run into the end of the year, as usually happens in November. And then December is kind of underwhelming. And this year's December was definitely underwhelming as well. Interesting. This is how an election year, first year presidential year typically plays out over the past 7 times. So there's a good amount of data in there. We could have gone further, but I thought this was a good, really since 2000, things have kind of shifted to a more technology-based economy. Things move a little bit faster, and really that's sped up through time. But I think there's a definite shift around that 2000 year and election era. So thinking about that. All right, the PE ratio, the Shiller PE is high. I haven't shown this in a while. Actually, last time I showed it, it was at this peak, and it was like, okay, we expect the market to be choppy and down for a bit, and it actually was. That was before 2022. We are now back up there. We're not as high as we were then. We're not as high as we were in the tech bubble in 2000, because after that, the market doesn't do much for a while. There's an Ed Easterling book called Unexpected Returns, which does a ton of research on this, and kind of suggests that the higher valuation this on the PE than the Shiller PE specifically projects how well the market will do going forward. When the market is overvalued is here, you're more likely to see a very big swings, very choppy market going forward. We had it, the last couple of years have been very good, but the year before that was very messy. So the expectations is that we're going to see bigger swings continue up and down at some point. So what I'm thinking about is next down, is it going to be much more than 2022 when both stocks and bonds got wrecked together? And that was ugly. So with the valuations high, that's not great, but at this point, it could still go higher. So we also don't have that euphoric blow-off phase where everyone and their brother and mother are like, hey, I need to be in stocks. And that's usually when you start knowing, okay, this is about to be done. So I'm keeping that in as well. Unemployment is a big factor as well. The slope of this red line here is the exact same slope of this one in 2007, 2008. Now, it hasn't spiked up yet, right? And we may be okay on this. It may be sooner, maybe later. This is also something that we watch pretty carefully, because once this starts taking off, we know something might be wrong, but we are definitely having that pregame slope of, things are not as good as they appear. Unemployment is steadily rising. It's kind of ground sideways for the past couple of quarters, but over the past 2 years, we're definitely seeing increase in that. And from what we're hearing, not a lot of employers are hiring at this point. So people are kind of sticking to their jobs. So that may be where they stay longer. And then on the other side, we're seeing a big drop in the old classic big name retailers going out of business. I mean, a handful of them did in this past year. And that's not great for employment either. So are those jobs shifting to tech or shifting to this new economy? I don't know. That's something worth thinking about, because the market doesn't collapse. It just has to change and evolve into new things. So we're in that phase where we're definitely going the old school, the old way of retail shopping, for example, is really kind of going away and becoming this new Amazon delivers everything to you for some reason. They've become a great shipping service of all things. So keeping that in mind, but the economy changes and evolves, but you do have to go through some rough times first. And that may be what sets us up for this unemployment spike if we do eventually get it. And I'm watching that all the time. The yield curve inversion that does typically precede a recessionary period by 12 to 18 months. Now that just went positive finally. It was down there forever and ever and ever. I believe around October, this third quarter last year went positive. So that would suggest that at least we're looking at October 2025 or somewhere in the first half of 2026. Imagine that 2026 again seems to be lining up as so many other things do, because we had this pullback or this inverted curve back here before 2020, and about a year later we had a problem around COVID. Now, I don't think we knew it was going to be COVID at that time, but we still, nonetheless, we got a very choppy, interesting, ugly market for a while. And the same here, back in 2007, it ground around flat as an inverted curve, and then when it uninverted, that's when 08 happened. So bad things tend to happen, but it's down the road. It's down the road. So I'm not too worried about that. But again, we're looking at that end of this year, early 2026 is just where things are starting to align, where it could be a little bit iffy, a little bit dodgy. I want to look for ways to play safe. But for now, we may be good. We may run and be safe for a little while. We're still not euphoric, as I said. This has been around forever and ever. I remember seeing this probably around 2008 the first time. I think this is just fascinating because this was supposedly done around 1872. Right. And somebody was talking about cycles, and cycles definitely do exist. And this is actually just a portion of a 4-page document. You can find it on Google. It's really interesting. And this came up when I was searching for cycle data on the 18-year real estate cycle, because I think that's very interesting. And that tends to coincide with a lot of these numbers that were put in place over 100 years ago, if not 150 at this point, long time ago. So yeah, this was saying that 99 should be a peak, and that predated a peak. 2007 predated. 2016 wasn't as much of one, but 2026, there it is, as foretold in this document from a hardware store in 1872. It's just fascinating to see these things come up, and then maybe 34, 43, and 53. I mean, I always keep this around just as a reference, or keep referencing it just to see where we are in these cycles. But these things do tend to happen again and again and again. There's also a great book, I think it's about the history of real estate cycles and banking, something which had the title of it. But that shows how there was a period it was 1818, which was so much like the 2007 financial crash. Like the same reasons for it happening were all almost identical. It was weird reading it because you're like, we just did this, but we don't learn from history, clearly. So I'm keeping that in mind as well. The cycle, again, 2026 looks like an iffy time. So we'll see. Doesn't have to, nothing has to happen, but I like to see where things converge. Now let's jump into our data section. Money flow is just ugly for December. Although the markets they were bad, but they weren't this bad, right? I would expect, an 8-10% pullback on this much money flow coming out of the market. But it really kind of came out and then just chopped sideways. The market didn't go down much more than 2-3%, and that was about it. Certain S&P did. I thought a 5% pullback would have been a little more expected, predictable, but that's not really what we got. It was really only about 2.5 to 3, so fine. I'm not really afraid of the market at the moment, but the money flow got real weird real fast, and we're shifting. We're way back to where we're very top heavy in those Mag 7 names, like technology stocks that are just driving this whole market, while so many are struggling, and even some are going out of business, like the big box retailers. So keeping that in mind, we are below this trend now. These big stocks are doing so much to float the economy that it may not matter for a little bit, but at some point one will. One way it's going to pull it, one way or the other. As I showed earlier, we could have this first January, February be more of a pullback if this continues, but at the moment it's just kind of stabilized. So I'm not too concerned right there yet. Here's what I talked about last month. We now have little dots showing when the market has, after a peak of money flow, and it starts to back off, to give us an alert to say, hey, we should start looking at and seeing if something is really changing at this point. Money flow is positive. We really had a great money flow return off of, I think it was around Christmas. This should have been the Santa Claus Rally. Didn't really happen, just kind of ground sideways, not really exciting. Now, to be fair, the S&P and the techs really didn't do well in that period, where things like value and small cap, they didn't get hit as much. They just kind of ground sideways. It wasn't exciting. It wasn't amazing. And you didn't really miss out by being in there. Being in the tech is where it didn't really help. Although that does feel like it's starting to shift back again. And then of course our sectors, as of right now, there are 0 sectors in the positive box. Again, doesn't mean they're trending down. Now a handful are looking pretty ugly. That would be these 4 right here: consumer staples, real estate, technology. Now in this, you got industrials, which are starting to turn above. You've got basic materials, which really ugly downturn, having move up as well. And then financials. Healthcare is another one we are watching, and then we might be buying that. It had a really ugly last few months, but it's really starting to turn, seeing some momentum pick up in there, and that might be worth checking out if it can move over to the positive side. But I want to see more confirmation of that first. And then finally, let's look at the rotation of these same things. Again, hey, here, healthcare about to pop into the improving box. That would be awesome, because that would mean we got momentum, because this is momentum up, positive momentum moving above treasury bills. And then once it moves up there, we expect it to move up into leading. And that's where strength is. While we've got the technology, communications, which is really just more technology, as well as consumer discretionary, are all kind of heading towards the exit, while we've got all these defensives setting up and starting to turn upwards. And that's when you see this convergence of a lot of the sectors moving up, then you typically see the S&P follow. And that's really why I look at the sectors grouped this way. So we're a little bit ugly. It's been ugly. It was expected. If you go check out my Twitter, I post these every week, so you can watch it week by week, and we can watch it play out, watch them go around the pond. I like to say the ducks going around the pond. So you can see where it's been, and this was expected. It's not unexpected where we are now, but now expectations mean it should push upwards and into improving and have a pretty good run. So that would go contrary to the seasonality of what we showed earlier. So, like always, we'll see how it plays out.